We looked at the types of share capital, types of share capital. We also looked at the prospectus. We also looked at statements in lieu of a prospectus, a statement in lieu of a prospectus. We also discussed something briefly about a misleading prospectus. A misleading prospectus. So we need to also know something about methods of issuing shares. Then there's something about maintaining the share capital, share capital, and the rule in Trevor versus Whitworth. The rule in Trevor versus Whitworth. The rule in Trevor versus Whitworth. Then there's something about reduction of the share capital, Then the last thing to know here is something about dividends. What is actually dividends? And there's something about dividends mandates and vouchers. So all this is what you need to be able to know under this particular topic of share capital. And I think we had discussed up to this particular level where we were talking about a misleading prospectus. So we simply said that share capital is a means through which a company can be able to raise its capital, or how it can be able to finance its business activities. One of the ways is through a sale of shares. If the company is able to sell shares, then it will be able to raise what we call share capital. So that money contributed in terms of after selling the shares is what we call share capital. So we looked at the different types of share capital, we discussed them. So we said we can have authorized share capital. Sometimes it is known as the nominal share capital. Or sometimes it can be known as the registered share capital of the company. So I think that one we noted down. So I don't need, I need to write it here again. So we looked at issued share capital, unissued share capital, reserve share capital. We looked at called up share capital and called up share capital, some of the types of share capital you can actually be able to have. And then we looked at the prospectus. So we tried to discuss what is actually a prospectus. We simply say that prospectus, it is simply a notice, or we can say an advertisement that is normally given out or issued out by a company, inviting the members of the public to be able to buy into either, it can be the shares of the company or maybe the debentures of the company. So at this particular point, when I mention shares, so I think you'll know very quickly what are actually shares. But of course, debentures, we look at them deeply, what we'll be able to understand what is a debenture when we'll be looking at the topic of debt capital, which is actually just the next topic after this one. So it is simply a notice or an advertisement that is normally given out by a company. That notice, we said it can be in a newspaper, it can be over radio announcements that the company is selling its shares. So they'll give out what we call a prospectus. So that is what we mean by a prospectus. We looked at the contents. So part of the contents of our prospectus, we said, basically, it will be talking more about the company itself, and of course, that particular prospectus in terms of the shares that are being given out by the company. So most obviously, from the prospectus, you'll most obviously tell the name of the company that is giving out the shares. There's someone making noise here. Is it George? George. You can mute yourself, I think. So if your background has some noise, you can just mute yourself, because if there's some noise in your background, it affects the others. It affects the others. They cannot actually be able to get the teacher very clearly. So just mute your background unless maybe you have a question. Is when you unmute. You just unmute and ask the question. But if there's no question, you just mute your background. Then of course just listen to the teacher. So we are saying part of the content of the prospectus will be, you'll be able to tell the name of the company that is giving out the shares. You'll tell the classes of shares that are being issued out by the company. You'll be able to tell whether these shares are being issued at a premium. So we can be able to tell whether the shares are actually also being issued at a premium, and actually explained what is actually a premium. So we say this is basically the amount over and above the par value or the face value of the shares, over and above the par value of the face value of the shares. So if each share is actually supposed to go at 10 shillings and the company issues at 12 shillings, the 2 shillings is actually the premium. And we said it is normally maintained in a share premium account. So you'll be able to tell also the directors of the company and what are the qualification shares they actually hold in the company. You'll also be able to tell from this particular prospectus other attachments that will be there. We said there'll be a report about the balance sheets and income statements. We said for the last 5 years, you'll be able to tell. Then also you'll get a dividends report of the company from the prospectus for the last 5 years also. And we said also if the company is to venture into a major project, then it simply means that there'll be a report by a special accountant clearly indicating what are the main reasons as to why the company actually intends to raise the share capital, So apart from just the other contents, these particular key reports are actually very important to be attached on the prospectus so that it can be able to tell the investor or guide the investor whether this is actually a very prospective company to invest in or not. So you said you can be able to tell it from these particular reports, because if you look at the income statement and the company is actually very profitable, so there has been a growth in terms of profits for the last 5 years. So most probably you can decide to invest in the company because at the end of the day, you'll be able to get good dividends from the company. So if the company has paid dividends consistently for the last 5 years, it can be a clear indicator or to you that this is actually maybe a very good company to be able to invest in. So we looked at that special report by the accountant. We said, for example, if the company is to venture into oil, there must be a special report by the accountant clearly indicating how the company intends to use the investors' money to venture into oil mining. So oil is actually a very valuable product. So most probably if the company has discovered oil and they're looking for capital to be able to mine the oil, it will be a very valuable company in the near future, maybe in the next 2 or 3 years. Once they start selling that particular oil product, it simply means that the company will become very valuable. And of course, if you bought shares at maybe 10 shillings, maybe after 2 years, the value of the shares will actually maybe be at 20 shillings. So these reports are actually very important to be attached on the prospectus so they can be able to guide the investor as to whether he can be able to buy the shares or not. So you can tell from that particular prospectus or notice given out by the company. So we said sometimes the company might decide not to go out publicly, but of course to do it privately. So they basically target private investors in the economy. So they know these people actually like investing. They are good at actually investing. So they approach them privately and they give them what we call a statement in lieu of a prospectus, simply a representation of a prospectus. But now in this case, it is actually done privately and it is not actually done maybe in a public way by maybe giving out notices in newspapers, but they just focus on those particular key investors and they approach them. So the keyword there is private, in a private way, privately, and give them as statements. It's just like a prospectus, but now in this case, it is now being given out privately to basically an investor or a prospective investor who is likely to invest in the company. And they convince this particular investor to buy the shares of the company instead of the company having to go out publicly by issuing out the normal prospectus. So he said if the prospectus contains what we call misrepresentation of facts, or basically information which is not actually factual or not true about the company, Such a prospectus, we said it is actually known as a misleading prospectus. So it's basically not giving out true information. For example, in this case, if they have clearly indicated in that particular report attached that the company has consistently made profits, yet it is not actually true, it simply means that that particular prospectus will actually be a misleading prospectus. So when we talk about a misleading prospectus, it is a prospectus which contains information which is not factual about the company, or contains what we call misrepresentation of facts. So those information which are not actually true about the company and they are contained there, the prospectus will be seen in wholesome as actually being a misleading prospectus. So say this one is not actually allowed under the law. And of course, if you as an investor, you ended up buying shares in a company due to a misleading prospectus, you have certain remedies. So the first remedies you can have remedies against the company. So remedies against the company. And of course, number two, remedies against promoters. We can have directors, or we can have experts. So also experts can be held liable. So these particular parties are liable because they are the ones who will sign, because part of the contents of a prospectus, it must be signed by the directors, because they are the ones who normally get involved in the preparation of the prospectus. So at the end of it all, before it is actually given out or issued out to the public, it must be signed by those who actually prepared it. So the directors are the ones who normally get involved in the preparation of the prospectus. So they'll sign the prospectus. Also promoters. So if you can remember very well, when we are talking about formation of a company, we say that, for example, in this case, if the promoter is forming what we call a public company, he'll be involved in the preparation of the prospectus to invite people to buy the shares of that particular public company on formation. And of course, you said he can be given commission as a way of remuneration for having basically been involved in the preparation of the prospectus, which basically invited people to buy the shares of the company on formation. So promoters also, if they sign the prospectus, maybe on formation of the company, they can be held liable if the prospectus is actually containing information which is not actually true about the company. Experts, these ones are actually basically liable because we've said here, part of the reports that are normally attached on the prospectus is, for example, a special report by an expert or a special accountant. So that special accountant is actually an expert who can be held responsible, because if he attaches or clearly provides a report to the company that is basically included in the prospectus, which is not true about the company, it simply means that that particular expert will be held personally liable or will be held responsible. And then also the company as a whole. So there are certain also remedies the investor can be able to take against the company itself as a whole. So before we look at deeply into the remedies, so maybe there's a question I want us to look at. So there's a particular question that was tested in a particular setting. Let me see if I'll be able to get it. So the question is here, it was tested in November 2016. It was tested in November 2016. It's question 1C. Question 1C. It's question 1C. Question 1C. Question 1C. So we can have someone read for us. We can have Lucy. Lucy, you can read for us the question. Or you can read the whole of question 1. The whole of question 1. Lucy. Yes, Lucy, you can proceed.
A company cannot own its own executes contracts. Describe 3 mechanisms provided by the Companies Act by which the company can sign documents. Green Park Limited issued a prospectus inviting members to a public to subscribe for its shares. It was stated in the prospectus that the money was required for the purchase of a modern equipment to be used for expansion of the company's business. On the strength of this statement, Rose Sagina purchased shares of the company, but she since learned that all the money received was used to pay the debts of the company, which were long overdue. Rose Sagina feels shortchanged and seeks your legal advice. Analyze the legal principles applicable in the above case and advise Rose Sagina appropriately.
So you can be able to see that that particular question is actually basically touching on a misleading prospectus, that this particular lady known as Rose Sagina relied on that particular prospectus of the company to be able to buy the shares of the company. So in the prospectus, they clearly indicated these particular amounts that are being raised out of the sale of the shares are going to be invested in the purchase of a modern equipment. But instead, the company went ahead and actually basically used the money for another purpose. So in this case, you can be able to see that Rose Sagina was actually shortchanged as a result of that particular misleading prospectus, So maybe we can just write the answer, then I'll explain deeply more about a misleading prospectus. You can just write the answer and say, the legal principles applicable relate to a misleading prospectus. The legal principles applicable relate to a misleading prospectus. Relates to a misleading prospectus. First of then you just say a misleading prospectus is a prospectus. A misleading prospectus is one, or just say is one, which contains, a misleading prospectus is one which contains, a misleading prospectus is one which contains misrepresentation of facts, misrepresentation of facts, which contains misrepresentation of facts, which contains misrepresentation of facts about the company, which contains misrepresentation of facts about the company, misrepresentation of facts about the company, or the intention, stroke purpose